We're back here on ETF Spotlight. Welcome, Jess.
Thank you.
We're going to plow on, and we're not going to talk about my haircut today. So we're just going to get through what this ETF is going to be. What we're going to talk about today is the S&P Dividend ETF. So I'm going to put it up on the screen to show our listeners. And this is a high yield. It's a dividend ETF with the S&P 500. But it takes a highest dividend yielding S&P Composite 1500 index and uses that index to look at which companies have been paying a dividend that's been increasing for 20 consecutive years. Do you want to just talk a bit more about this ETF, Jess?
Sure. Right now, when we look at developed markets, this is ultimately a developed market ETF, specifically a U.S. market ETF. We look at considerations around what parts of the market are you actually trying to invest in, and what parts of the market do you want to avoid. And so this position addresses some of the concerns of our investment committee in a couple of ways. One, that dividend screening component of looking for companies that have consistently produced a dividend income that's been distributed to shareholders over a long period of time across a wide segment of the market. So this, in addition to picking up primarily large cap stocks, there's some small and mid cap exposure here. And we believe, particularly in a choppy market climate, companies with a dividend paying history are likely to produce better returns and less volatility. The second piece that's important about this position is what it screens out. So there's a little more complexity around it, the position selection, but ultimately, unlike some dividend ETFs, this position helps us to screen out positions where the dividend is inconsistent or where the company is paying a dividend relative to the share price where they're distressed. So it's important to consider both the companies that you want in your screen and the companies that you want out.
Because it's a pretty healthy setting, isn't it, to filter that it's picking out of the universe of 1,500 S&P stocks, it's picking the ones that have paid a rising dividend every year for 20 years.
It looks at rising consistency. A long-term dividend-paying strategy means that companies that, for example, would have performed badly during the financial crisis or another period in time ultimately get screened out. So there is a high quality bent, a high consistency bent that's going to be important in the stock selection here. That's part of why this is one of our core holdings.
And I've got the fact sheet up while we're looking at it. In the top holdings, HCP, AT&T, Chevron, there's Caterpillar, which, if anyone doesn't know, produces all the big tractors and farming equipment for mining companies, which has been going very well for the last 10 years. I'm not sure if that's slowing down. But when you look at the sectors, the financial sector is 24%. There's a good spread. There's 13-14% in consumer staples. There's 6% in healthcare. There's a good spread of mid, large and small cap companies in those sectors.
Yeah, absolutely. This position is diversified. It covers a wide segment of market cap, of sector, and part of when we look at how do the building blocks of our portfolio work together, we like the fact that we get quality large caps, we get some small and mid cap exposure, and we get some diversity across sectors.
Now, when we're looking at what's coming up, we've got the US elections. We're not going to get into politics of Democrat or Republic or Trump or Clinton, but are we looking at this ETF in terms of what's happening in the current environment with the politics? Because the US does affect everything else.
Sure. I think where this position comes into play, and part of our macro positioning right now is that we are concerned about increasing volatility going into the U.S. election. And regardless of your political views, our concern is that a Trump victory would represent uncertainty and somewhat of an unknown and historically volatile quantity, and we think markets may not react very well to that. So, as there are challenges really on both sides of the party, depending on on how the elections play out, and both looking at what happens with Congress. So we view positions like this one that have a bias towards quality and dividends as being more stable, more reliable going into an uncertain period, and being ultimately more defensive. Now, certainly positioning around the US election is something we talk about almost every day. And our view is it's still a little bit too early to make any definite calls about the potential outcome and the implications of that. But it's something that we continue to watch quite closely. And going into various events this year, we've talked about Brexit, we've talked about other challenges that world markets have faced. The decision to remain in dividend paying stocks and to have a bias towards value and quality has been in part to better defend ourselves against pockets of volatility and events that could trigger undesirable reactions in stock markets.
And that's what I like about this ETF is to filter out companies that in any cycle, because every year you and I talk, even the last week of trying to record this video, it has gone up and down with news of Clinton and Trump, and he's now doing this and she's now doing that, and all that sort of
Well,
news.
and interest rates are doing this,
Yeah.
right? There's a lot of moving parts right now. So, we continue to believe, and this isn't really a new message, but I think it continues to be a really important one, that for all investors right now, it's critical that you know what you own and you like what you own, because there are events that potentially create more volatility. By owning quality, by owning positions, that you continue to have a good long-term horizon view, and you don't care ultimately if you have some pockets of short-term volatility, because you have confidence that you've picked segments of the market that you expect to maintain their value over time and ultimately produce growth.
And this is the big piece, which is, 20 years ago when everyone was doing stock picking and trying to pick these stocks, we can now just easily pick this ETF, which goes back to our methodology of, look, it doesn't really matter what the news is going to be. There's always going to be news. There's always going to be something that's going to be headlines. But here's one with its vetting criteria that automatically picks companies that have paid a dividend in any environment for the last 20 years in a row. So this is just what the technology is allowing us to do, is to pick up these ETFs very cheaply. If I actually look at the not that I want to get into fees, but just to show people that when we are looking at these ETFs, the costs on these are just so low compared to what you had to do years and years ago.
Yeah, absolutely. And in a low return, a potentially low growth, or a higher volatility environment, fees matter, taxes matter, other ways that you can potentially enhance total return, even if it's a few basis points here and there. It's ultimately important.
And we're holding 109 stocks right now. 109 stocks in this. I actually can't find the. I'll have a look at it and put it on the email later. But anyway, it's less than 0.5%. I'm pretty sure. But 109 stocks to do that, and 20 years ago you'd have to go out and stock picking all these individual stocks. Okay, so when we're moving forward now, we'll put out some more material on what we think is happening in the next part of this year with interest rates and governments and all that sort of thing. But in terms of this ETF alone, what are we looking at doing in terms of underweight, overweight, adding, subtracting in terms of the portfolios that include this ETF?
Currently, we remain overweight U.S. equities, and we believe the lack of tremendously attractive alternatives is likely to support the current equity price environment. U.S. stocks aren't cheap anymore, but we, on a relative basis, believe they are still attractive, and we're still comfortable owning them. However, because we're in a higher PE environment where U.S. stocks have performed very well in recent months, we do continue to look at that quite closely and look at the outlook for forward valuations. And certainly going into the election, if we expected a high amount of volatility or uncertainty, or had concerns about the price movements around those events, we ultimately could reduce this position, hold more cash, or potentially increase it if we felt international markets had less to offer. So we've got a lot of flexibility right now. I think the message to investors is ultimately that we're watching positioning quite closely and remain flexible and aware going into what could be a bumpy and challenging fall.
Excellent. All right. Well, thanks so much for your time, Jess. We've just touched on 10 minutes, so that will do us for today, and we'll put some of these on the email, and you can have a look at the fact sheets. up on our ETF Spotlight on the web. Thanks very much. Bye.
All right, thank you.